Hello everyone, this is Dr. Mihir Shah once again with another video. In this video, we will be solving December 2022 university question paper under the subject direct tax. This is the second part of a video series based on solving direct tax December 2022 question paper. We have already solved one sum in our part 1. Now let us see which are the other sums which were there in the paper and how to solve them. Again, a very important video for all the TYBMS Sem 5 students. Now, the next question, which was there was Professor Rajesh, a UK citizen, not a person of Indian origin, is a visiting faculty at JNO University, provides you the detail of his visit to India during the last 7 years. Okay, now here the assessment, you always look at the assessment year. Assessment year is 1920, so my previous year will be 1819. So 1819 is our previous year, so it's been marked, I'm just marking it here. Okay, and thereafter they are giving you 1, 2, 3, 4, 5, 6 preceding the previous year they have given us. So I'm just noting it down. Okay, prior to 1st April 2012, before this date, he did not visit India, so he never came to India. Okay, find out his residential status for the assessment year 1920. Okay, now very simple. We'll first note down the rules and then we'll see how to solve it. Okay, now name is Professor Rajesh. Assessment year is 1920. Previous year is 1819. Mr. Rajesh, a UK citizen, will be a resident of India if he fulfill one of the following condition. Number one, he is in India for 182 days or more in the previous year. Or 2A, he is in India for 365 days or more in the 4 years preceding the previous year. We hide the previous year and then we go backward by 4 years. And he is in India for previous year for 60 days and more. Okay? So those are the two rules. Now from those two rules, any one of the rule has to be fulfilled. One, either 182 days or more, or 2A and B together. So let us check now the computation for residential status. In the previous year 1819, he was there for 179 days. So as per the first rule, he has to be in India for 182 days or more. So he does not fulfill that rule. So this rule is not. So this condition cannot be fulfilled. Now he has to be in India for more than 365 days in the 4 years preceding the previous year. So we don't have to look at the previous year. Go backward preceding it. So 4 years ka 17, 18, 16, 17, 15, 16 and 14, 15. We add up the number of years that days that were given. It came to 530. So fulfilling the 2A condition. And second condition is along with that he has to be in India for more than 60 days. Yes, that also gets fulfilled. So 2A and 2B, both the rules are getting fulfilled. Observation, Mr. Rajesh fulfills the second condition. Conclusion, he is a resident of India. Okay. Now the rule comes. If he is a resident of India, so we have done first part of the sum where we have proved that he is a resident. Now the rule comes as if he is a resident, now we have to prove whether he is an ordinary resident or not an ordinary resident. Okay. So now the second part, computation for ordinary resident. Now when will he be called as an ordinary resident? Mr. Rajesh will be an ordinary resident if he fulfills the following conditions. Number A, he is in India for 2 out of 10 years immediately preceding previous year. We go backward 10 years preceding the previous year. He has to be at least 2 complete years. Or he is in India, sorry, and he is in India for 730 days out of 7 years immediately preceding the previous year. So again, previous year preceding, in the previous 7 years, he has to be at least 730 days. So let us see the computation. So previous year we don't take that, we go ahead. So there are 6 years ka data given. So we note down the 6 years ka data 195, 15, 130, 190, 100 and 125. When we add up the 6 year ka data which was given, it came to 755 days, thus fulfilling the 730 days wala clause. Observation, he is in India for 755 days in 7 years preceding the previous year, thus fulfilling the condition. Conclusion, he is a resident and an ordinary resident of India. So this is how you'll have to solve the sum based on residential status. Okay. So I hope everyone understood that sum. Only the rules and based on the rule we just have to compute. Okay. Chalo. Now let us check which was the next sum which was there in this paper. Mr. Kamlesh purchased a house property for 1 lakh on 27th August 1998. Remember, any house which is bought before 2001, that rate cannot be taken. The value cannot be taken. He made the following additions and alteration to the house property. First, construction of the first floor in the year 2003-4. Second, in the year 2010 and 11. The fair market value of the property as on 1st April 2001 was 15 lakh. Now, this is the fair market value. The rule is if the property is purchased before 2001, that value cannot be considered. So we'll have to take the fair market value. So that's my acquisition value. That is the price of purchase price. Okay. He sold the property on 20th October 2018. That is my previous year for 1 crore 95 lakhs, and he paid brokerage of 55,000. The cost inflation index are given for 2001 to 2, 3, 3, 4, 10, 11, and 18, 19. That's our previous year. Compute the capital gain of Kamlesh chargeable to tax for the assessment year 1920. Okay. Always remember, we always start the sum with sales less brokerage or transfer fees. So number one, sale consideration 1 crore 95 lakhs less brokerage 55,000. So we get a net sale consideration as 1 crore 94 lakh 45,000. Now the next step will always be less cost of acquisition. How much you had purchased, we need to get the index rate of that. So index cost of acquisition ka formula is cost of acquisition into CI of previous year upon CII of year of acquisition. So we'll take the fair market value of 2001 because we cannot go beyond 2001. So 15 lakhs into CI of previous year is 280, and upon CI year of acquisition, this value is of 2001 and 2001 ka rate is 100. Remember, numerator will always be the previous year, bottom will be of which year ka value this is taken. We multiply, we divide, we get the value as 42 lakhs. After cost of acquisition, always remember there will only be one cost of acquisition in the sum. Improvements can be multiples. There are two improvements given in the question. So index cost of improvement, the formula is cost of improvement into CI of previous year into the divided by the year of CI in which the improvement had taken place. 13 lakhs was in the year 3, 4 when the CI was 109. So 13 lakhs into 280 upon 109, and the 14 lakhs was in the year 1011 where the CI was 167. So 14 lakh into 280 divided by 167, we get the value that 3339445 and 2347305. Sale less index cost of acquisition less index cost of improvement gives you a final answer. Long term capital gain as 95 lakh 58,250. This is how you'll have to solve the sum based on computation of capital gain or long term capital gain. Very simple. Just have to keep the format in mind, the three steps format: sale, index cost of acquisition, index cost of improvement. And if at all there are any new purchases, that also will get subtracted at the end. Nothing is added in this sum. Okay, from the start till the end, it's only less, less, less. That has to be remembered. So that was the second question, question number 3 that we solved, and second question in this video. Let us check one more sum which had appeared in the paper. Following is the profit and loss account of Mr. Prakash for the year ended 31st March. He has given you one PNL account. Remember, whenever PNL account is given, always it will be some based on computation of business and profession. Okay? And they are giving you other information. Always remember, business and profession will always come as computation or tax or total taxable income. So your sum will get divided in 3 parts: income from business profession, income from other source, less deduction under chapter 6A. Okay. Now remember, whenever PNL account is given, we'll always first give the heading as income from business and profession. Under that first will always be net profit. We'll start with net profit 1,28,000. Next, we add all expenses which are disallowed. Disallowed meaning anything which is not to do with business related expense will all get added up. So all our personal expense, all our capital expenditures, okay, anything which is for your own self, okay, all personal, charity, donation, all that gets added up, which are not business related basically. So salary and wages is a business expense, will not appear in the sum. Provision for doubtful debts. Always remember, bad debts is an allowed expenditure, but provision RDD is not a business expense. Hence, it is disallowed. Will appear in the sum. Printing and stationery is a normal business expense that should not come, but there's an adjustment on that. Fourth adjustment number 4. Okay, there was an adjustment number 4 to it. Printing includes 2,500 paid for printing marriage invitation card. This is personal, so will appear in the question. Advertising expense shouldn't appear in the question, it's a business expense. But advertising expense include 9,000 for advertisement in souvenir political party. That's personal, will appear in the question. Entertainment allowance is a normal business expense, shouldn't come. Miscellaneous expense, again business, shouldn't come. Staff welfare, normal business, cannot come. Bad debts, normal expense, cannot come. Interest on capital personal will appear. Income tax is personal will appear. Depreciation normal case में shouldn't come, but if there are two depreciation, one in the question, one in the adjustment, the one in the question will get added, the one in the adjustment will get subtracted. So one will come in add, one will come in less. Drawing is personal, so will appear. Okay, there's only one adjustment we didn't take into consideration. Prakash has invested some amount in mutual funds, so that comes under deduction, so that we'll see later on. So that's it. These were the expenses which we tick mark. So we have provision or doubtful debt, advertisement for political party, interest on capital, depreciation, printing card for marriage, drawings, and income tax. We added up and we put it on the auto column, so it became 1,37,500. That is all your expenses which are disallowed. So that will get added to our net profit later on. Now next comes less income disallowed. Now what are the income which are not business related? Agriculture income not business related. Dividend from Indian company not business. Interest on bank deposit not business. Interest on bank deposit again not business expense. All are disallowed. All will appear along with the depreciation. The second rule. So agriculture income, dividend from Indian company, interest on bank deposit, interest from company deposit, and depreciation. All those come under income disallowed. We add up, we get the value as 80,000. So 1,28,000 plus 137,500 minus 80,000. The total comes to 1,85,500. That is my first answer. Income from business and profession. Towards this, we will add now second part. Income from other source. Other source, you will have to look only at the income part. The agricultural income is an exempted income, will not come. But dividend from Indian company, interest on company deposit, and interest on bank deposit, all the three will come under income of other source. We add up, we throw it outside, and from business and profession, we add 35,000 more. We get our first, the gross value, that's called gross taxable income of 2,20,500. To that last step, less deduction under Chapter 6A. There was only one investment which was made, 75,000 mutual fund. That comes under Section 80C. So 80C is mutual fund, 75,000 ka deduction, 2,20,500 less 75,000 will give you 1,45,500. This that is our net taxable income. Okay, so this was sum based on computation of total income. Okay, I hope everyone have understood all the three types of sum that we did in this particular video. Okay. There are few more sum we will be taking up in the next video. Okay, I hope everyone have understood this. Okay, chalo. With that, we will be ending this video here. Thank you.